You buy a 3 times leveraged ETF. The index goes up 10%, so your ETF should be up 30%, right? Not necessarily. Sometimes far less. A fund like TQQQ is targeting 3 times the NASDAQ 100's daily move, not 3 times the long-term result. That target resets every day. After gains, effective leverage drifts lower. After losses, it rises again. The reset is what restores the fund to roughly 3 times exposure for the next session. The cleanest proof is a simple 2-day path. If the index goes from 100 to 110, then falls to 99, the index is down 1% overall. A naive long-term 3 times expectation says 97, but the actual daily reset path lands closer to 91. That gap is the mechanism people casually call decay. A useful approximation is that the extra drag grows with leverage and with volatility squared. The term is leverage times leverage minus 1 over 2 times sigma squared. For a 3 times product, that simplifies to about 3 times sigma squared. So when volatility rises, the drag does not rise linearly. It accelerates. Reset drag is only one part of the story. Leveraged ETFs also face explicit fees and embedded financing costs from the derivatives and collateral structure used to maintain leverage. So the right mental model is not one fee. It is several structural headwinds acting at the same time. Fees, financing, and reset-related drag. In a strong, smooth uptrend, the market can overpower them. In a choppy market, they can dominate. Path dependency is the core risk. A steady bull trend can let leveraged exposure shine. A volatile sideways path can bleed value even when the average market move looks harmless. And a crash followed by a recovery can still leave the leveraged holder far behind. Same market average. Different path. Very different result. This risk is not theoretical. TQQQ's long-run annualized return since inception has been extraordinary, but it also suffered a drawdown of more than 81% with a brutal recovery path. Those two facts can both be true. Strong long-run upside does not erase the possibility of psychologically unholdable drawdowns. Here is the clean recap. 3 times means daily, not long-term. The 2-day proof shows why the naive expectation fails. The extra drag rises with leverage and volatility squared. And beyond reset drag, leveraged ETFs also face fees and financing friction. This video is for education only, not investment advice. Always read the prospectus and decide whether this path risk is appropriate for you.